All right.
Welcome to Launch and
This
Learn.
meeting.
I'm gonna move around here a bit. You've got your facilitator, Loretta Garcia, and you
Hi.
are here in Kaufman, Southern Tier Incubator. We're excited to, get to know our numbers before they know us, right? I
Yeah.
have a special guest dialing in from the New York City area. He spends much of his time with entrepreneurs, startups, and helping them get on track. Sometimes goes by the name of a fractional chief financial officer. Please welcome, and I'll let you introduce yourself a little bit more, Shane Anglade.
Hi, everyone. I'm Shane, and I'm the fractional CFO at Anglade Advisory. I basically help businesses between 1 to 10 million grow profitably and as they scale and grow in their business. A little context about my background. I've worked 6 years in FP&A in companies like Ralph Lauren, Paramount, and Universal McCann doing the FP&A for their marketing teams, such as like their fashion shows or campaigns or big brand moments for these companies. And I have now have my own fractional CFO this to translate that corporate rigor that a lot of these big companies have into small businesses that may have like one or two or three people, but don't have that financial strategy or strategic planning for their business as they grow to be profitable and be the best business that they can be. Today's presentation is basically about a big part of what I do, which is cash flow planning. Cash flow plan is basically seeing what comes in and what comes out for your business and planning around it to make sure that there's not any type of cash crunches for your business as you go throughout your months and make sure that you're just always have cash available, which is a number one reason why businesses fail, which is lack of cash flow planning and right pricing. So oftentimes with business owners, you're working with your accountant or your bookkeeper or your accounting system, and it says that you're profitable for the month. You have revenue that's coming in, and you're like, I have a good month on paper. But a lot of time in your actual bank account, you don't see that money hit your bank account all right away. So you see that you had a great month, but you feel broke right after like you had a great month, and you're wondering why that's the case. And the main reason because of that is something called like a cash timing gap between what you've earned on paper versus what you actually have in your bank account. And that's when cash flow planning comes into handy because you could see what's coming in and what's going out and when they're supposed to happen. So you can align your cash with when bills or anything is due. So you're not having cash crunches when you're just last minute thinking like, how am I gonna get the money when I don't have the money yet? Even though it says that I've earned it on paper. So profit is not cash. And I'm going to say it again. Profit is not cash. So accountants and you might be working with them and they're saying you're profitable this year or you're profitable this month. That doesn't always translate to you have the cash at hand for your business. To explain, profit is what's earned on paper. So profit is basically, for example, if you had a 3 month contract and you signed it in January, but the money's supposed to come in March, then you don't have the money now, but the cash is supposed to come in March, and you're profitable in accounting terms because that's seen as money earned, but you don't have the cash right now in January. So for a quick understanding of like the difference, profit is a scoreboard. It's a scoreboard to see like I'm doing well as a business, I'm doing great as a I'm eventually gonna get money, and I've earned it due to legal accounting metrics of earning cash, earning money. And cash is the oxygen of your business. Cash is when you get money in hand. So after that contract is finished and you're supposed to get that money on March, that's when you get the cash, and cash is the oxygen that you can make decisions for your business, and you can use it to like do the whatever your day-to-day operations you need for your business at that moment. All right, the five reasons that cash goes missing is usually um, one of these five reasons that makes your cash flow tight throughout the course of your business. It's usually stuff like late client payments. You might had a client that you invoice for net 30, which is basically 30 days after the invoice is given to them. They're supposed to pay it 30 days after. And then they ask for an extension to pay it. So maybe it's net 45. You were expecting it to come after that 30 days, and you're planning to use that money for that day, that 30 day that it came in, but now it's coming on day 45. And that messes up with your cash flow planning. And then maybe you had bills coming in on that 30 day that you didn't necessarily know that you weren't going to get the money for. So it gets pushed out. And that's also makes a cash timing gap because you have expenses you have to pay for that you didn't necessarily know you weren't going to have the money for. Then two is paying supplier upfront. So with a lot of inventory-based businesses, they have to pay suppliers like right at purchase of their purchase orders. And that's a big cash crunch that can take away from the runway of your business. So when I say runway, that's basically the cash you have until your business runs out of money. And it causes you to not have the money to make decisions for, I don't know if you had to do a one-time expense for, I don't know, a app or something that you had to do for your business that like you needed at that moment. And now it makes your money that you have available tighter because you use that on an upfront payment that was like a huge chunk of your money that you had already. So, a next one is tax bills. One thing about life is death and taxes, and we all have to plan for it. And that's the thing a lot of business owners forget that they have to do, especially when you have an LLC or like, you have to plan for how much money you're putting aside for taxes each quarter. So when you get a tax bill and you spent all the money that you thought you had that because you see that you were profitable, you you didn't put the money aside for a tax bill, and then you have to pay all that out of pocket when you necessarily didn't have the money that you should have put away for that tax bill. And slow months. So a lot of businesses are Q4 heavy. So holiday times, they have like they're getting so much revenue because that's like their peak time in their business. But they don't think about, okay, what happens in January? January revenue goes down sharply, and for a lot of business, and they have to have a cushion from what they built in Q4 with holiday and use it for January to float the times when like the revenue is not as stable. So slow months can make your cash timing gap if you don't plan for that ahead of time. And big one-time expenses. Um, there's always something that can happen with a business. Business owners know that one-off things happen all the time. So sometimes a one big time expense can make your cash tighter than you expect. So that's why it's always good to have set asides for cash buffers or reserve for things that are emergencies that are not necessarily planned for your business. So your projection helps you see these before they actually hit, and you're just able to, plan ahead, and that helps you with your decision making versus being reactive in the moment, without a plan. So we'll give you an example of a business owner, like a case study. This is Maria. Uh, Maria runs a small marketing agency. She has two retainer clients. She takes project work when it comes in. And her revenue goal each month is $12,000 a month. For the month of March, she had her best month ever. She had a revenue of 14,500, which is higher than her revenue goal that she's expected. She has cost of delivery, which is basically the cost to put on her services of 3,200. She had overhead of 3,800, which is basically her operating expenses to run her business. And the profit from that, which is basically a revenue minus all those expenses, is 7,500. So her net margin, which is basically the percentage of cash that you take home after all expenses are taken, is 52%, which is a pretty healthy net margin to have. Usually 50% and higher is pretty good for a business. And but there's an issue. But on April 12th, she only has 3,200 in her bank account. And her bills are totaling of 5,400 were due in 3 days after that April 12th date. So she did well in March, but she's realizing in her bank account she only has 3,200 and she has bills that are more than that. So there's something that we have to plan for ahead of time to make sure that she's not gonna run out of cash. Maria has a gap that is happening in her cash flow, as you can see. She has a retainer that lands. Her starting balance is 3,200. She has a retainer that lands April 15th. She has a retainer B that's late. And that's what I was talking about earlier with sometimes clients obviously pay late. A lot of business owners feel that they say they're going to pay this one time and you're like, oh, it's 15 days later after that. So that retainer is being paid later in the month. She has a project invoice that lands later in the month as well, and she has bills and taxes that are due on April 15th. So you can see in the cash flow table, she starts with retainer A that comes in on April 15th, where it brings her 3,200 to 7,200, but she has bills also of 5,400 that's supposed to be taken out the same day. So that leaves her bank balance of 1,800. So this is all our numbers. I'm just letting you guys know when you have a low point where you see 1,800, it should be something of concern because what happened if there's something that is a big expense that has to hit, or you feel tight with your money and you need to even it out so you don't feel like you're on edge if something an emergency happens or if like anything that can happen with your business. 1,800 for her is a low point. So she's identifying that as a part that could have been fixed with a buffer from like maybe the last month, or it could have been asked like retainer B to pay earlier so there wouldn't be such a cash crunch on the April 15th. And you can see from this, she landed okay with the month. As retainer B paid later in the month. But that date in April 15th was a dangerous point for her and something that she could have evened out if she pulled certain levers to make sure that her cash flow was more steady. We can go over like a couple of things that Maria could have done. I kind of explained some of it already. If Maria had seen the April 15th date earlier, she could have asked for earlier payments from one of her retainers and see that and have it maybe on April 14th. So she will have enough cash so there's not a cash crunch on that April 15th date. She could have hold cash back from March. As we went over, Maria had a great month in March. So if she had that 90-day projection, she could see like, oh, I could put money aside for my slow month where I'm not gonna have as much cash available and put it for April so that cash crunch is not so deadly to me and I'm not having enough cushion for my business. And she could have requested a partial upfront payment. So a lot of times with retainer clients, you could say you could pay a certain amount now and a certain amount later. That could have helped with the cash crunch and having a buffer for her business. And she could have moved a contractor payment by a few days. So a lot of times with even your bills, you could pull levers. So you can say like, I want to pay like, except on net 30, you want to pay net 45. And you accept, so you could pay, except for paying in 30 days, you could pay 45 days, and that frees up money for your current month, and you won't have such unsteady cash availability. So
I was just thinking, is it a good rule of thumb to for a new business
Hmm.
to just not spend unnecessary funding and put it all in the account and let it build up? That way when you have a area where you get stuck or short for cash, that money is there and available to use.
Yes, yes. Putting reserves aside is very important, especially when you have slow months, when you're not
Huh?
expecting money to come in. So I'm going to definitely go over that example as well. But having a cushion is always needed. Like having a cash buffer for your business is always needed for any business. Having a buffer to like reinvest into your business is also good as well. So yes, that's perfect. Perfectly said. Sorry, you're on mute still. Oh,
Thank you.
yeah, no problem. So we're going to see how a clean month looks like. So starting off from the last month in April with Maria, she ended that month with 2,300. So both um, both her retainers paid on time, which is May 15th. She had normal bills go out, that 3,900 that you see right there. And a new project invoice lands later in the month. So she got extra money on in May. So the results are that her bills are covered, her balance grows, and there's no dangerous timing collisions that happens that's happening for her business right now. But since she has such a good month, you're going to see the next month for June that she's going to use the cushion from this month to supplement a slow month that she has. Because as you see, she has an extra new project invoice at the end of the month. But that's going to be used to help supplement a slow month. And that's what I was talking about with like Q4s or like a busy season for a company and having that carry over to move to other slow months to help bolster it up so you're not having cash crunch when you're not expecting as much revenue. So yeah, Maria's June month, the cushion does its job. So she's starting her balance with 1,900, $900 dollars. She has no new projects. So she has her regular retainers that she's normally gets, her two retainers that we spoke about earlier. She has a tax bill that's due, but the month is slow. She's not getting any new business. Um, she's just on flying steady right now, but it's nothing that's giving her a cushion for future months. So she's using that 3,200 that was that new project from the last month to help her with the slow month that she's getting for because as you can see, a new project is zero for this month. So June just stays manageable and there's no scrambling needed because she planned ahead that she's going to use that money and put it to the side for the slow month. And that's what most cash flow planning, financial planning advises you to do for these periods. And also, context, you don't want to take out any loans and cash crunches if you don't have a plan of like when you're going to get money back as well. So a lot of time businesses see like, oh, I'm having a slow month, I can't pay my bills, and they're like, I have to take out a loan. A lot of time, sometimes you might need that, but if you had a cash flow plan and knew like when your money was going to come in, you could see ahead of time what you could push around in order so you won't have that tight squeeze that you would have to take a loan out to supplement your business. Yeah. So the full 90-day picture is April had a timing gap as we went over. That was when she had that April 15th date that was very tight for her business. May rebuilt the cushion, so she had an extra project that she had that she was used as put aside for June, which was the where she used the cushion. So she had a tight month, and then after that, saw like, okay, I have extra funds. Let me put that aside for a month that's not going to be so slow. So she learned from her April situation to not have such a tight cash um, runway for her. And the 90-day projection shows that. It shows where the risk is, it shows where the buffer is built, and it shows where you can breathe. So April was the risk, May was the buffer, and then June is where you could breathe. So you might want to know how to build your own projections, and it's pretty easy. As you can see, you don't need like a whole fancy system. Um, a lot of companies have such complex um, uh, FP&A and financial planning tools to help them with this because like once you scale, you need like more visibility into what's coming in, what's going out. But if you're a small business owner that's just starting off, or if you need to just track what's going on with your business and see when there's going to be t on cash tight crunches, you can do this with a simple Excel or just writing down on your papers how to make this projection. So you start with your bank balance for currently. That's and then after that you list money coming in for the next 3 months. Then you list all the money that's going out for the next 3 months. And then you add the actual dates these things land are due. And then you carry each month's ending balance into the next month. So, for example, you list what's coming in, which is like your revenue, retainers, projects. You list what's going out, like bills, payroll, taxes. You map when it hits, write the exact dates, and you check your balances at the end of each month when you're adding up when the money comes in for each month and you're landing for each month. Yeah. So pick one of the actions that you wanted to do this week. List what you're owed and when it should land. List every bill that's due in the next 30 days and calculate your runway. And that's pretty much what make you more calm as a business owner and also give you more clarity into how your business is running as well. So um, if you guys needed help with that, I work with businesses that are between 1 million and 10 million that need assistance with their financial clarity and knowing how to be profitable over time. But I also have one-time uh, engagements that also help with you having that visibility for your business as well. And you could take that QR code to figure that out, to find my link tree, and then you guys could go to see my services. But that's pretty much it.